Good evening. Welcome to the Loan Officer Training Series with the Mortgage Calculator. Tonight, we're going to talk about how to structure purchases with seller held seconds. Give us just a moment here to go live on all the different platforms. We do stream this live on all the different platforms, so give us a second to get up and running here. We got the chat up on the screen there. Feel free to drop a comment there in the chat as you tune in. Go ahead and check in. Appreciate it. Hope everybody is having a great evening and ready to get into this very unique topic here for tonight. So it looks like we're live on all the different platforms, so we'll go ahead and get it started. What we'll do is we'll take the chat off the screen for now, but go ahead and keep dropping comments there in the chat and check in as you tune in. And you can drop any questions you have in the chat about the presentation today as well. So, welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a lender that specializes in non QM loans. And what we do every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern on this show is go through a in-depth loan officer training. And tonight's training is going to be on how to structure purchases with seller-held second mortgages. So getting a little tricky here. I'll go ahead and turn it over to Jose so we can get the presentation started.
Good evening, everybody. Thank you for joining us for tonight's training on how to structure purchases with seller held second mortgages. Now, this is very unique option here. We do have great options for this structure at the Mortgage Calculator. So let's get right into it here. I'm sure you're all chomping at the bit to find out how do we get this done. So, what exactly is a seller held second mortgage? For those of you that may be wondering, tuning in, thinking it sounds like it's cool if you don't know what it is. Well, it certainly is. A seller held second mortgage is a mortgage where the property seller is financing part of the down payment that is required by the first mortgage. So, that's really important to note because the first mortgage, usually in these transactions, is the one that is going to control um, the restrictions like the maximum CLTV, right? So one thing to note, very important, is that this seller held second mortgage needs to be disclosed to the first mortgage and taken into consideration when analyzing the CLTV limits allowed by the first mortgage. I mean, the seller, he's holding paper. He doesn't care. I mean, if you're negotiating, I mean, they do care. Maybe they only want to hold a certain amount of paper, right? But I mean, in a transaction, for the right type of transaction, it is a common occurrence. And in some cases, maybe the seller would be willing to hold the difference. However, that's usually not going to be possible because the first mortgage is going to have a limit on the LTV as opposed to the CLTV. The LTV is the loan to value, CLTV is the combined loan to value. So, this maximum combined loan to value allowed by the first mortgage will essentially determine the borrower's minimum down payment requirement. Now, what you have to be aware of, again, you have to note that CLTV requirement because in most options that we're going to find out there on these non QM products that will allow these high LTV options, because you can do this CLT combined option on agency loans also, right? You can go up to 95% on those CLTV, but then you're going to be looking at the LTV and CLTV that you're allowed on the first, by the first, right? So now we mentioned here in this slide how it needs to be disclosed to the first mortgage and taken into consideration when analyzing CLTV limits allowed by the first mortgage, right? So, with that being said, how do we properly document the CLTV in in your system. We use Encompass, so these two images here that I put one on top of the other is from our Encompass system. So first thing, if you are in Encompass or whatever system you are there that you're using, there should be some type of a subordinate financing tab that you see there. I'm in the sales summary screen there in this top section here. And when you do click that subordinate financing tab, that opens up the screen that you see down here, where, for example, in this scenario, if I have this second mortgage also set up in my LOS, I'm going to click link to the loan that's already in there, and that's going to populate that second mortgage information in here, and then it'll populate all the stuff you see down here: the LTV, the CLTV, the closed end primary mortgage, closed end subordinate mortgage total, right? If I don't have any loan linked in my LOS, I'm just going to click add new closed end second, which is what I'm adding here, and then manually input the information so that the LTV and CLTV correctly reflects where we are at. Now, please do make sure that the correct payment amount populates in the subordinate liens P&I that is going to be part of your payment. Your payment is going to be made up of your P&I on the first, and then below that, you have the subordinate principal and interest, so that the DTI reflects the seller held second mortgage payments. Whatever it may be, we're just talking about having it reflect. So if this was, for example, a conventional loan where you're going up to 80% LTV on the first, you want to have that seller held second, so that borrower doesn't have to give that other 15% down payment, only giving 5% down payment, and then you don't pay mortgage insurance. That's similar to what when we do our HELOC combo loans, right? When we don't want any MI, so we go up to a 95% CLTV, 80% LTV, for example, on the first. We usually like to do it when it's a condo and we have 75% LTV on the first, which, by the way, this is another scenario where you could do that. However, the condos, remember, only go up to 90% CLTV when it's a limited review condo. So I'm just showing different structures where you're going to be able to use a seller held second as opposed to an institutional second like a HELOC or a second mortgage where you're trying to do a combo loan, right? And the seller held second is just a different option, and we're talking here about the different ways to structure. However, the one that is probably going to be the most exciting one, and I saved this one here for our final slide here where we can get into it. The most exciting option when we're talking about seller held seconds is going to be our 90% CLTV DSCR purchase transaction. Now, do remember we do have an 85% LTV DSCR purchase. Now, that one is 85% LTV and 85% CLTV as well. So you would not be able to take that one any higher than it already is. And that's going to be the case, what you're going to find in most of the non QM options, the 80% or the 85% max option on all non QM investment properties is going to be the maximum CLTV if it's an 85% option. If it's an 80% option that you're looking at, it's also going to be max 80% on the CLTV as well. It's really only in the, for example, conventional ones when you look at, those are high LTV programs to begin with. So if it goes up to 95 LTV, it's going to allow a 95% CLTV as well. Now, this particular option we're talking here is the DSCR that has a 90% CLTV. So that is an amazing option because it is a no ratio DSCR purchase that allows up to 75% LTV on the first mortgage, combined with up to a 15% LTV seller held second mortgage. So you can do any combination of those depending. I mean, if you have a really sweet seller held second, the seller really wants to hold some paper, um, then so be it. You could have a nice seller held second, and let's say do 60% on the first and 30% on the seller held second. But usually it's the other way around. Usually the seller held second, since they are in second position, is going to be a higher rate than the first. There's usually not going to be any benefit to having a higher seller held second than 15%, unless you have some issues with the first where they're not going to 75. Normally this product goes up to 75% for purchases, and for cash out refis the same. They don't lower the LTV when it's a cash out refi, which is great, 75% on both options. But should it be a scenario where, due to property type, they may only go up to 70%, then again, CLTV is still going to be 90%. Now, as I was stating before, the structure is only possible when the CLTV on the first mortgage allows it, because it has to be a disclosed transaction, right? That second mortgage has to appear on the closing statement as an additional source of funding. It cannot be a silent second or an undisclosed second where, like, some funny business goes on with the title company documenting those funds as something other than what they are. They are a secured seller held second, right? That gets calculated into the CLTV. Now, rates on this, I mean, I don't really want to put rates on there because rates change all the time. But depending on if the borrower wants to buy down the rate a little bit, I mean, we have some buy down options on that program where the rates on the first are in the low eights, right? Pay a couple points, you're going to get something in the low eights. Pay no points, you'll probably get something in the high eights or maybe like the very low nines. So then those are very good rates. Remember, this is a no ratio DSCR, and we're talking about a CLTV up to 90%. And that's a critical point to consider, because a lot of times the critical factor on setting up a first with a seller held second is that the income isn't going to work, or the DSCR isn't going to work. Well, that's not a consideration with this structure. When it's a no ratio DSCR, that means they're not considering that. You do have to have a lease in place. If it's a refi, well, then again, you wouldn't be doing this for the refi. This is for the purchase. But no ratio is key here, because if the seller agrees to whatever you're doing, whatever the payment is, the additional monies, the liability that's being incurred isn't going to be taken into consideration. And as long as the first is good to go, your seller held second is going to be good to go. And best of all, for those of you that might not know what 90% CLTV means, only a 10% down payment, right? So we have this option is for 1 to 4 units. This option can also be possible for our 5+ units, right? So for those of you looking to get those commercial types multifamily transactions, we are able to structure this option for those as well. So definitely very interesting here at looking at 10% down for this type of a transaction that normally would require 25% down. So definitely look to the mortgage calculator for us to structure your seller held second transactions, along with the over 5,000 other products that we have that we can put together for you for non QM purchases or refinances.
All right. Thank you, Jose. I don't see any questions, but definitely amazing stuff there tonight. I'll give it just 1 second to see if any questions pop in because it's a great topic here. Well, I don't see any questions coming in. So I guess you did a great job then, Jose. Great explanation. So we'll go ahead and wrap it up then. Remember, we do this at 7 p.m. Eastern every Tuesday, Wednesday, and Thursday. So we will see you all tomorrow with a new training topic tomorrow night, 7 p.m. Eastern, for the next episode of the Loan Officer Training Series